The South African economy grew 3% in quarter two, which some analysts are saying is good, but not good enough. Joining me down the line to discuss her perspectives on the matter is Razia Khan. Razia, on Friday, the Reserve Bank Governor said there were downside risks to the bank's latest forecast of year-on-year GDP of 2%, and that this was mainly because of electricity constraints. What did you make of today's figures, and what are the biggest economic hurdles for South Africa at present?
Well, first off, although the quarterly growth rate is 3% in Q2 looks like an improvement in Q1's very weak 0.9% quarter-on-quarter growth rate, really it's little more than a reflection of the weak base. We had seen an outright contraction in manufacturing in South Africa in the first quarter, and we saw some recovery, more of a statistical recovery in manufacturing in the second quarter. Yes, there were some positives across a range of sectors, retail, finance. We did see sufficient momentum to suggest that growth may continue to improve, but there are also big downside risks facing the South African economy.
At the same time, a depreciating currency and rising wage and salary costs have also been cited as pushing the inflation trajectory upwards. Some analysts are expecting a figure as high as 6.9%. The official expectation is 6.2%, but what is your outlook?
Well, first of all, one needs to keep a sense of historic perspective about this. South Africa, of course, has an inflation targeting framework in place. The main objective for the South African Reserve Bank is price stability, and they do take that objective very seriously. However, there will be events such as the rand weakening in reaction to the planned tapering of quantitative easing that are well beyond the control of the Reserve Bank. And it's largely as a result of recent rand weakness, the volatility in the currency because of global events, that has fed into domestic fuel prices, that has allowed inflation to rise temporarily above the upper level of the inflation target. Now, there are two key things here. One is, to what extent is this breach of the inflation target going to be sustained? And just how bad does it get? How bad it gets depends on how much of a sell-off we see in the rand. Will we see a lot more volatility? In which case it's possible that the breach could be in a fairly wide range, around 6%. However, if it turns out to be fairly limited, and certainly looking at the growth picture in South Africa, with the economy continuing to underperform relative to its potential, then it's very unlikely that this breach of the inflation target will be sustained. In setting interest rate policy now, the South African Reserve Bank needs to look at what inflation will be doing in the future. So in a sense, it's already too late to react to the current breach of the inflation target. It's worrying, but it isn't necessarily something that policy should respond to.
According to the Financial Times, Kenya is moving ahead with plans to launch a debut $1 billion sovereign bond before the end of the year, despite an already large budget deficit. Places such as Senegal are adopting a more wait-and-see approach. Could this exacerbate Africa's intercontinental economic disparities?
Well, yes, there has been a trend for some time of other African economies, the smaller African economies, pulling ahead. There is much more positive growth momentum. Those economies typically are more insulated from what's going on globally. South Africa is the region's largest economy, an established emerging market with deeper linkages to the global economy is not as well insulated. So yes, there is a different growth rate. One should also take into account, however, that the South African economy is significantly larger than other African economies. As an illustration, for South Africa to add 1 percentage point to its growth rate would imply growth that would be the equivalent of a Botswana growing about 27% in a single year. And that should help us a bit with the perspective. Unfortunately, unfortunately, the South African economy is underperforming relative to its potential. 2% growth, as we've just seen year on year, is still too weak for South Africa. But one would expect, given its relative maturity, that its growth rates would, in any case, fall short of the 6 to 7% growth that we see in the rest of Africa.
Despite the lacklustre growth and struggles with inflation targets, South Africa is bucking the EM trend by not setting plans to prop up its currency. The rand has been one of the worst performing EM currencies this year, but there seems to be no sense of currency crisis here. Why would you say this is, and what is your outlook for it moving forward?
South Africa has long had this tradition of not intervening in a big way in markets. Now, there are downsides to that approach, of course. It creates a great deal of difficulty for economic management. There is more volatility in the currency, but by leaving it to markets, what the country might also see is eventually some boost to its performance, its export competitiveness if the rand does weaken. For the moment, of course, policymakers are concerned. They're concerned that given the general weakness of the external environment, even though there are pockets of recovery here and there, and of course greater optimism regarding US economic prospects, exports have not necessarily reacted yet to the weakness of the rand. Now, the fear is that what they might get from a weaker rand is higher inflation, but may not necessarily see a competitiveness boost. However, despite that fear, we think it'll take a great deal more volatility for the South African authorities to rethink their long-standing approach of basically leaving it to markets to determine the value of their exchange rates.
Razia, it's been a pleasure speaking to you. Viewers, that's all from me for the moment, but click back to the website for our Commodities Corner focusing on base metals. Goodbye for now.